Good morning, friends. Hope you're all doing great. Having finished off with income tax in our previous session, today we shall be starting the very important topic of capital gains tax. Now, what is this capital gains tax? Very simply, let's try and understand this with the help of an example. Supposingly, you bought a particular piece of land and then subsequently sold it off on a profit. Now, this profit that you've made on this particular piece of land, you will be liable to pay capital gains tax on this land, on this building that you have now sold off on a profit. So very simply, this is what is capital gains tax. Now, before we start, one very important bifurcation I would like to tell you that individuals, I can just grab my pen, individuals pay capital gains tax. As opposed to this, companies or corporate houses, companies pay corporation tax. They are very much the same thing. Just the names of these two different taxes is as per the applicability of these two taxes. So individuals would pay capital gains tax, companies would pay corporation tax. So let's start off with what is capital gains tax first. Capital gains tax, on the short form we call it CGT, is for personal taxpayers, and corporation tax CT is for companies applied to gains less losses arising from chargeable disposal of chargeable assets made by chargeable persons. So three very important terms we've done here. We need again less losses arising from a chargeable disposal being made by a chargeable person and of a chargeable asset. So we've got three terms to understand which basically arise the capital gains tax for any individual if it's a capital gains tax, for companies if you're talking about corporation tax. So three terms that we have to understand. First being, let me just grab my pen, a chargeable disposal of a chargeable asset being made by a chargeable person. So we've got three terms to understand in order to understand when is the liability for capital gains tax, that is CGT, arising, right? So let's have a look at each of these terminologies one by one. So now what is a chargeable disposal? Chargeable disposal definitely includes, chargeable disposal means a sale, right? It means disposing of or selling of a particular chargeable asset. So it is going to include either you sell it off, that is sale, or even if you have not sold it off but you have gifted the asset to any other person. So both sale as well as gift of a chargeable asset is going to be including, is going to categorize as a chargeable disposal. Now what happens if I have not sold off my asset, I have not gifted my asset to anybody, but due to the nature of the God, some natural calamity has happened resulting into a destruction of my chargeable asset. That loss or destruction of a non-wasting asset is also going to be considered a chargeable disposal. So when the asset gets destroyed by act of nature, also considered a disposal of the asset. Also considered when there is a receipt of a capital sum like an insurance compensation, destruction or damage of a non-wasting asset happening, that is also going to be considered a chargeable disposal. So any asset being sold off in the market at open market value, being gifted at zero value, or getting destroyed, all are considered chargeable disposals, thus arising a liability towards capital gains tax. Now what else? What is going to be considered the date of the disposal, that is the date of the chargeable disposal? It is either going to be Definitely, generally, what it is going to be the date on which the asset is actually sold off. So definitely that is going to be the date of disposal. So generally considered when the asset is sold or is transferred in case it's a gift. What happens when the date, when there is a contract to be signed off in order to materialize, in order to legalize your sale. So then the date of disposal is going to be considered the date on which the contract is actually signed off. If in the contract there is a particular condition that needs to be met, in that case, the date of disposal is going to be considered the date on which that particular binding contract condition is being met, is being fulfilled. So that is going to be the date of disposal. So the date of contract is signed where the asset is transferred requires a contract, or if the contract is conditional, then when the condition is met is going to be considered the date of disposal of the asset. What about when the asset is lost under destruction? So definitely when the loss or destruction actually occurs, actually takes place. What happens when you actually receive some insurance compensation? That will also be considered a date of disposal. The date when the capital sum is being actually received by the transferor of the asset. So these are all the dates of disposal of the chargeable asset. What else? What about assets whose disposal would not be considered a chargeable disposal? So basically, disposal which is considered an exempt disposal. So let's have a look at disposals which are exempt from any CGT liability. Why? Because they are exempt disposals. So such a disposal made does not attract any capital gains tax liability. So we're looking at gains are not going to be chargeable to tax, and loss is thus not going to attract any sort of relief. On losses we have reliefs, but such a loss incurred on an exempt disposal is not going to attract any relief. So the loss is not eligible for any tax relief. When do you think that is going to happen? The date when any exempt asset is being transferred from the transferor to the transferee. So the transferee acquires the asset at its market value on the date of disposal. However, the day there is liability towards no liability towards CGT arises. Why? Because it's an exempt disposal. It's not a chargeable disposal. So let's have a look at what sort of chargeable disposals are going to be considered not exempt but at a no gain, no loss, which basically means that they are going to be transferred from the transferor to the transferee at cost without making any gain or without making any loss. Simple example, let me just open my sheet. Supposingly, Mr. X had bought a particular asset for £100. Now the same asset he transfers to his wife, Mrs. X. At what rate do you think this inter-spouse transfer is going to take place? Definitely at a no gain, no loss. So the same cost of £100 which Mr. X had incurred now becomes the cost of Mrs. X. So this is the cost as well as the selling price for Mrs. X. So this is the selling price for Mr. X and this becomes the cost for Mrs. X. It has been transferred at a no gain, no loss. The transfer has happened. The transfer has happened. Ownership has transferred. However, there is no gain, no loss accruing from such a transfer. What else? Let's have a look at situations wherein there is going to be no gain, no loss for such a transfer, thus not resulting into any capital gains tax liability. So no gain, no transfer, no gain, no loss disposal happen when the proceeds values are deemed equal to the transferor's cost. Thus, there is no gain and no loss being made. The transferee acquires the asset at the cost to the transferor itself. So basically, the cost to Mrs. X is what it had costed Mr. X to buy the property, even if it was, say, 10 years down the line. Example could be disposal of a chargeable asset between husband and wife or between civil partners. Why? Because such a transfer is going to happen at no gain, no loss. Just the ownership is going to change. There is no profit being made, there is no loss being made. Thus, there is no taxation liability arising at such a disposal. There is a disposal, but there is a disposal at a no gain, no loss circumstances. Also, so between civil partners, between husband and wife, also when there is exchange of shares following a capital reorganization of the company. So instead of £1 shares, I am now selling my shares at 50 penny. I have just reorganized the capital of the company. Definitely there is no change in the structure. Only the number of shares have changed. The structure has changed, but there is no gain or loss arising from the shares held by an individual. If I had 100 shares earlier on, now with the reorganization of the company, I will have 200 shares of 50 pennies each. So definitely there is no gain, no loss. Also no gain, no loss when then there is a takeover of one company by another company. Why? Because only the ownership is changing. There is no physical gain or loss on the shares happening here. Why? Because only a notional change in the ownership of the asset is happening here. So under all of these circumstances, this is when basically we make a no gain, no loss disposal. Now that we know what is a chargeable disposal, let's quickly revise this. So chargeable disposal can be when there is a gain or a loss made on a particular asset which is being transferred. Also, there are a few exempt disposals. Because they are exempt, it does not attract any CGT liability. Also, there would be a few chargeable disposals which would be considered at a no gain, no loss circumstances. Why? Because these are disposals which happen at a no gain, no loss, thus no CGT liability occurs under such circumstances. Only CGT liability happens when a chargeable disposal is made of a chargeable asset, either resulting into a gain or a loss on that particular disposal. So this is what we are going to tax under our CGT regime. Now that we know what chargeable disposals are, let's have a look at what are chargeable assets which will, when subsequently being sold off, attract the capital gains liability. So any asset, unless it is specifically exempt, so any asset unless being specifically exempt will be called a chargeable asset. So all chargeable assets are what? Any asset which is specifically not exempt. So we work on an exemption basis. All assets are chargeable assets unless they are specifically exempt assets. So let's have a look at what assets have been specifically exempt from any capital gains tax liability. One is the first is the taxpayer's principal private residence, that is one home the taxpayer is allowed to have, live and subsequently sale of without attracting any capital gains tax liability. The first being the principal private residence or home of the taxpayer. Also, qualifying corporate bonds, that is you are issuing quoted sterling bonds, commercial debentures, all of these are exempt from any capital gains tax liability. Any government securities, marketable gilts, non-marketable premium bonds, again you're only trying to encourage people to actually go ahead and make these investments. When you sell them off, they will not be subject to any capital gains tax liability. What about chattels? Now, chattel is a new term for you. Let me explain the term chattel to you and what sort of chattels are specifically exempt from income tax liability. So, let's have a look at the term chattels. It basically means any chattels are what? Chattels are any tangible movable property. So we've got two properties of chattels. They are tangible, which means you can touch and feel them, and also they are movable. They can move around. So definitely all properties are chattels if they are tangible and they are movable. So chattels, few chattels specifically mentioned are exempt from corporate gains tax liability if they fulfill any of these three criteria. First chattel that is exempt from a CGT liability is a wasting asset. Wasting asset basically means the useful life of the asset is less than 50 years. So any asset which has a useful life less than equals to 50 years will be called as a wasting asset and does not attract any CGT liability. Also, if the asset is a non-wasting asset, which means the life of the asset is more than 50 years, but the value of the asset in terms of the sale proceeds and the cost of the asset is less than 6,000 pounds, again it would be exempt chattel. So any non-wasting chattel with current market value and cost less than 6,000 pounds, this rule exempts low value items of movable plant and machinery. So it would be considered as a non-wasting asset less than 6,000 pounds of value. So an exempt asset from CGT liability. Also an exempt chattel is motor cars including vintage and veteran cars. So three types of chattels are exempt assets exempt from any CGT liability. Let me quickly make you revise it. So where do we start off with? We start off with the chargeable assets. Chargeable assets are all assets except if they are exempt assets, exempt from CGT liability. So let's have a look at a few exempt assets. The principles for one, private principal, private residence, one house, you can definitely have. Government securities, marketable bonds like these, definitely you're encouraging that you hold these assets. Also, exempt assets are chattels. Let me just open a new page. Exempt assets are chattels. Now, what is a chattel? Chattel needs two qualities. It should be a moving asset, moving as well as tangible. So, any property which is moving and which is tangible would be called as a chattel. Three types of chattels are exempt chattels. Three chattels are exempt assets. Let's have a look at all these three. First being if it's a wasting asset. Wasting asset basically means that as the life of the asset is less than equals to 50 years. So if it's a wasting asset, it's an exempt asset from CGT liability. Also, if it's a non-wasting asset, that is life is greater than 50 years, but the value in terms of market price and in terms of cost is less than 6,000 pounds. Again, it would be considered as a non-wasting asset. The third type of asset, which is an exempt asset, would be motor cars, including vintage cars or any veteran cars. So all these sorts of motor cars do not attract any CGT liability. They are exempt chattels. So very simply, what's the chattel? If it's a moving and a tangible property, three types of chattels are exempt from CGT liability. If it's a wasting asset, that is life is less than 50 years. If it's a non-wasting asset, but value is less than 6,000 pounds. And if it's a motor car. Now let's have a look at few other exempt assets. They are exempt if it's a foreign currency that you hold when you're traveling abroad for, say, a short vacation you're going. You've carried some foreign exchange. This foreign exchange has now seen a rise. You make a notional gain, definitely not liable for CGT liability. So, foreign currency acquired by an individual for the purpose of meeting personal expenditure outside the UK. Definitely what it is an exempt asset. Decorations awarded for valor unless they've been acquired by purchase, which basically means you performed some act of bravery. The government HMRC awarded you a gold plate. Subsequently, you go ahead and sell off this gold plate, make a profit. This profit would not be liable to CGT liability. Why? Because this award, the subject matter was awarded to you for a cause, for a valor that you had performed, for a bravery act that you had performed. So definitely not liable for CGT liability unless, of course, you had actually gone on to the physical market, purchased this gold plate at a particular cost, and then subsequently sold it off at a profit. Then that profit would definitely be liable for CGT liability. What else? Investments held in NISA. We've all done that. We're just encouraging people to hold on shares, cash, subsequently sell them off, make profit, do not attract any capital gains liability. So all of these assets are exempt assets, exempt from CGT liability. So if all of these assets are exempt assets, let's have a look at broadly what sort of assets are going to be covered, which are going to be called chargeable assets. So let's have a look at a few list of principal classes of chargeable assets. Definitely comprises land and building, shares of a company, goodwill of a business, high value, which basically means cost and market price both more than £6,000 of non-business, non-wasting chattels like jewelry, works of art. All of them are chargeable assets. When you sold them off, you are subject to pay capital gains tax. High value business plant and machinery, but if sold at a gain, because otherwise you can claim a capital allowance on it. Wasting assets other than chattels like a copyright, all of these are chargeable assets. So all assets except if they are specifically exempt assets would be categorized as a chargeable asset. So all of these assets are chargeable assets. So till now what we've done a chargeable disposal of a chargeable asset. Now that we know this, who actually makes this disposal? By a chargeable person. So now let's have a look at who is this chargeable person going to be? Who's going to be liable to pay CGT liability? So let's have a look at chargeable persons to start off with. Chargeable persons are what? They are individuals if they are resident of the UK and you've made a gain on disposal of a chargeable asset, you are liable to pay capital gains tax to the UK government. Similarly, for companies, if it is a UK resident company, again making a chargeable disposal, making a chargeable gain, you are liable to pay capital gains tax to the UK government. Definitely, chargeable persons are who are people who are residents of the UK. So let's have a look at what is this chargeable person? Chargeable person is any person. For individual, should be a UK resident. Remember, we had done the UK resident ties. We had done the UK resident test. You've lived more than 183 days, you become automatically UK resident. Apart from that, you perform the test of ties. How many ties have you actually qualified, whether or not you will be assessed as a UK resident in a particular tax year or not. Similarly, for companies, if the company itself is a UK resident company, again, you have to pay CGT liability. You are liable to pay capital gains tax or corporation tax for in case of companies. right? Let's get back to the rules. Now, how do you actually calculate your capital gains? Very, very simply what it is. Broadly, I'm sure everybody would understand this concept. How do you calculate a gain or a loss? What do? You consider your selling price, which is your disposal proceeds. You reduce from your disposal proceeds any cost which was incidental, which was mandatory for you to incur in order to materialize this sale, like a legal cost for that matter. If you had to incur in order for this sale to materialize, you need to bring down your sale proceeds by the amount of incidental cost of sale. So what do? You reduce the incidental cost of sales and then arrive at the net consideration. From your net consideration, you definitely reduce what? You reduce your cost of the particular chargeable asset. So you reduce your cost. Now this cost for capital gains tax purposes is going to be of three types. The first cost be the acquisition cost plus any incidental cost of acquisition, which basically means the cost at which I had acquired the particular chargeable asset which we have now subsequently sold off. So definitely you're going to look at what cost did you actually acquire it at. Also, if at the time of acquiring you had to incur any incidental cost of purchase, that gets added, that gets capitalized to the cost of the asset itself. Also, up next you're going to look at any cost of enhancement, which basically means you purchased a particular piece of land, you had to incur certain repair work on the land and building, you had to incur certain expenses, certain renovations needed to be done in order to enhance the value of the asset, and then it has been subsequently sold off. Definitely, yes, a very much part of the cost of the land and building, which has now been subsequently sold off. So, any cost of enhancement gets added in the cost of the particular asset. Also, you need to include any cost of preserving, maintaining, and basically your cost of preserving, maintaining, or defend the legal title to the particular asset. So any cost which you had to incur in order to prevent, in order to defend your legal title to the particular chargeable asset, definitely it is what? It is very much a cost that you had to incur on the particular asset which is now being subsequently sold off. So definitely you need to reduce all these three types of assets in order to arrive at a chargeable gain. So this is how you arrive at a chargeable gain. Let's have a look at the pro forma that we need to follow in the exams. Please follow the exact pro forma. Now remember, this pro forma is for personal taxpayers. It's for individuals only that we are doing as of now. So what do you take? You start off with your sales consideration, reduce any incidental cost of sales, arrive at the net consideration, reduce three types of allowable expenditure on cost, which is acquisition cost, including an incidental cost of purchase, any enhancement expenditure, and expenditure to establish, preserve, or defend the title to the asset, thus arriving at the chargeable gain that you have made on the particular asset. So this is how you're going to calculate your personal tax for your CGT liability. Right, now that we know this broad layout, let's understand a few of these terms and what all it can encompass. What are the rules? What do we need to understand when we are talking about all of these terms? So what do you understand by disposal proceeds to start off with? Definitely these are the sale consideration. This is what you physically sold off the asset for. This is how much you've actually received by the sale of the asset. So for sales made in the open market value, you're going to take the gross selling price of the particular asset. What happens when this gross selling price becomes the cost for the future disposal purposes for the purchaser or the transferee? Very, very simple. Let me just show it to you. Mr. X sold a particular piece of land to Mr. Y for say £100,000. Now this £100,000, Mr. X, this is the selling price for Mr. X. The same £100,000 is the purchase price or the cost to Mr. Y. So this is what is we are referring to here, that gross selling price becomes the cost for the future disposal purposes for the purchaser or the transferee of the particular asset. What next? What about incidental cost of disposals? Remember, we had added on a few incidental cost of disposals in purchase costs and reduced the same incidental cost of purchase when we are calculating the disposal proceeds from the particular asset in order to calculate the net consideration of the asset. It includes what? Includes valuation fees. It includes advertising cost. It includes legal cost. It includes the sales cost, auctioneer's fees, brokerage agency fees, any of these costs which you had to incur in order to materialize your sale. In order to actually physically sell off your asset, you have to incur these incidental cost of sale. So very much a part of your sales itself reduces the value of sale proceeds of the asset, thus arriving at the net consideration of the asset. Now, what about enhancement expenditure? Capital cost of additions and improvements, provided they are incurred wholly and exclusively for the purpose of enhancement of the particular asset. So, we are looking at enhancing the value of the particular asset wholly and exclusively for the purpose of enhancement only. We are now selling off, we are now enhancing the value of the asset which is going to be further sold off. Now, how do you actually calculate this? Now that we know the basic terminology, we know the layout, how do we actually go forward by after calculating this chargeable gain? What sort of taxable, what are the tax rates which are going to be applicable on calculating the gain of the CGT liability? So what do? Calculation of tax payable. What are the rates which you are going to apply? Quickly grab some water, please. Right. So what it is, your capital gains tax liability is either going to be 10% or 20% depending upon what band rate taxpayer you are. Are you a basic rate taxpayer for your income tax point of view, or are you a higher rate taxpayer from your income tax point of view? So what you basically do, you've got two band rates here, 10 or 20%, depending upon what threshold of band rates are you at. That thresholds are the same as that we've done for our income tax computation. Now, apart from this basic normal 10 and 20%, if the said chargeable asset is a residential property, then this basic and higher rate tax band changes to 18% and subsequently higher is 28%. So very, very simple. Let me just quickly go through the rules, then I will explain it to you once again. If taxable income falls within the basic rate band, the rate of CGT is 10%. If the same rate is 18%, if the said property is a residential property. If taxable income exceeds the basic rate band, the rate of CGT is 20% or 28% for residential property. So very, very simply, what do we have? Right. You calculate your chargeable gain. You're liable to pay CGT on it. What do you calculate? Depending upon what sort of a band rate payer you are. If you're a basic rate taxpayer, the rate is going to be 10%. If the said chargeable asset under consideration is a residential property, Then the same rate becomes what? The same rate becomes 18%. Also, if you are a higher rate taxpayer, that this is up to 32,000 pounds. This is above 32,000 pounds. The rate of liability, CGT liability, changes from 10 to 20%. And if it's a residential property under consideration, it is going to be 28% from the basic 18%. So this is how you need to calculate your CGT liability. Also, if disposal qualifies for entrepreneurial relief, don't fret about it too much. We're going to do a full-fledged session on it. So if it qualifies for entrepreneurial relief, then the rate is going to be 10%. What is now this taxable amount? What is the amount of tax that you're going to pay? Let's have a look at. Definitely, you're going to first begin with your current year gains. What sort of gains have you made during the current year under question? Out of this current year gains, you first knock off the current year losses on other assets that you have made with respect to capital gains liability. So current year gains, reduce your current year losses first. Then thereafter, after having reduced your current year losses, then you can reduce any of the brought forward capital gains tax liability losses that you have brought forward from the previous excuse me, for any brought forward losses from the previous year. So first, what do? We start off with the current year gains, reduce any current year losses, and then reduce the losses which have been brought forward from the previous years. Also, we reduce, like for our income tax, we have our personal allowance. Similarly, for capital gains tax, we have been given an annual exempt amount of 11,100 for 16-17. So, you reduce this applicable base rate of 11,100 from your taxation liabilities. So, what it is for 16-17, the amount of rate changes to 11,000 pounds, 11,100 pounds as the annual exempt amount. So, very quickly, what do? You make a capital gain in the current year on a particular chargeable disposal of a chargeable asset. In the same year, on some other chargeable asset, you could have very well made a loss, right? So, what do? You reduce the amount of capital loss of the current year from your current year gains. Now, having settled off your current year first, now you can actually reduce any brought forward capital losses from the previous year. So, any brought forward capital losses can now be brought forward and thus knocked off in order to arrive at your net capital gain. Now, before you calculate your net gain, also like personal allowance, you are being given an annual exempt amount of capital gains, which is how much? 11,100 for 16-17. So, very clearly, you should know how you calculate your taxable amount liable to pay CGT tax. So, very simple that you start off with your current gains, knock off your capital losses of the current year, reduce any brought forward losses, thereby reducing any annual exempt amount of 11,100. The net is the amount of income that you still have to pay capital gains tax upon. Right? So, let's have a look at what is the method that you're going to decide what is the rate that you're going to pay your tax at. Now, remember, this taxable amount, I said, would be either paid at the normal rate of 10% or would be paid at 20%. If it's a residential property we're talking about, this rate changes to basic rate of 18%, thereafter at a higher rate of 28%. So, if you're a basic rate taxpayer, you pay 10 or 18. If you're a higher rate taxpayer, you pay 20 or 28% as tax as capital gains tax. So how do you basically decide it, what level of taxpayer you are? Basically what you have to do, it is deemed to be added to the taxpayer's taxable income. So whatever is your income tax liability, is your income tax in your taxable profits under income tax, you add on your CGT capital gains. Then find out whether or not you are above or below the basic threshold level of 32,000 pounds. So this is the basic threshold level upon which you're going to decide which sort of taxpayer you particularly are. However, separate computations are going to be done for income tax and for CG purposes only. You're going to add it up just to find out what sort of a level of band rate player you are in terms of your CGT liability. Now also it results into an extension of your basic rate band. Remember your extension of the basic and higher rate band? It was happening when you were making any personal pension contributions, any gifted scheme, which resulted into an extension of the basic and the higher tax rate band. Now, like I said, here there are only two bands. Either you are a basic player if your income is less than 32,000 pounds, or you are a higher rate taxpayer if your income is greater than 32,000 pounds. So 32,001 pound, right? So very simply add your income tax taxable profits to your chargeable gains taxable profits. Find out what level you are. Is it more than 32,000 pounds or is it less than 32,000 pounds? Depending upon that is going to be the level of threshold level you are going to pay your tax at, either at 10% or at 20%. This rate changes to 18% and 28% if it's a residential property under circumstances. So let's have a look at how do we basically do it. Now what happens supposingly, very simply, let me just put it here. I said that the basic rate taxpayer pays 10% tax if it's a residential property. You pay 18% tax if you're a basic rate taxpayer. Also, if you're a higher rate taxpayer, you pay 20% tax on any normal asset. If it's a residential property under disposal, you're going to charge it at 28%. How best do you think we can tax plan? The annual exemption limit of 11,100 definitely needs to be knocked off against the higher rate residential property first. Why? Because at least up to the level of 11,100 pounds, it is going to reduce you paying the higher rate of 18 and 28% respectively. So this is how, if taxpayer has chargeable gains from residential property and other assets, it is beneficial to apply annual exempt amount to the residential property of the asset. Very simple. All you have to do is that, why? Because you would want to pay a tax at 10% instead of the residential property of 18%. You would want to pay tax at 20% at the higher rate instead of the residential property rate at 28%. So better tax plan that your first 11,100 pounds can at least be reduced from your residential property gain. Now let's better understand all of these rules with the help of a few examples that we have. Let's begin with example 1. Peter sells a chargeable asset on the 10th of June 2050 for 71,000 pounds. So that is your chargeable disposal before the selling cost of 400. So definitely how much you've actually sold it off for? You've net sold it off for 71,000 pounds less 400 pounds. He acquired the asset on May 1st, 1993 for 10,000 pounds. So that is the cost. Let me grab my pen. That is the, why my pen is not there. That is the, why my pen is not coming. So that is the cost. My pen is not working for some odd reason. Why is the highlighter highlighted? Okay. No. No. Okay, let me not write it. I will just type it. I don't know why it's just showing some sort of an error. Right, so this becomes the cost of the assets. I had purchased it for an original cost of £10,000 and incurred additional capital expenditure of £3,000 in June 1997 and 2,000 in May 2004. So definitely some enhancement cost has been incurred on the particular asset before being subsequently sold off for £71,000 in June 2015. Part A of the questions asks us to calculate the chargeable gain arising in the tax year 15-16. Part B of the question tells us a little further deeper. We go into the question. Calculate the CGT payable for the tax year 15-16, assuming Peter's taxable income of £500,000 and he does not make any gifted donations or pay contributions in personal pension scheme. Because that is there is going to be no extension of the, I'm unable to write, so just leave it. There's going to be no extension of the basic and the higher rate bands. 20,000 he does not make any gift or donation and pay contributions to personal pension scheme. Part C, £30,000 and he pays contribution of £12,000 gross into a personal pension scheme. Definitely contribution to a personal pension scheme results into an extension of the basic rate band by the gross amount. Remember, there is going to be no extension of the additional rate band. Why? Because there is no additional rate band. There are only two bands available here, basic as well as the higher. £140,000 and he pays contribution of £30,000 gross into a personal pension scheme. So let's solve this question one at a time. Something seems to be wrong. Why am I not able to write anything? Is it not an editable file? Let me just open it once again, please. So what it turns out that apparently there seems to be some problem here. Not able to write anything. Even the option to edit is not available. I'm not able to edit my file. So let me just check why I'm not able to edit my file. Right, so looks like finally I'm now able to write something. Right, so at least typing is now okay, fine. So what do? We start off with calculating our chargeable gain arising by selling off the asset. So how do I do that? Chargeable gains. I first start off with the sale proceeds. What is the sale proceeds? The sale proceeds are sold off for £71,000 less incidental cost of sales being how much? £400. I arrive at my net consideration. Of £70,600 is my net consideration. From this, I reduce what? I definitely reduce the various types of costs which I would have incurred on the purchase of the asset. The first cost being acquisition. cost which is given to me. How much is the acquisition cost? Purchased it for 10,000 pounds, right? So acquisition cost is 10,000 pounds. Also, I've been given a few 10,000 pounds. Also, I've been given a few enhancement costs. I've been given two enhancement costs, one for 3,000 and another for 2,000. Thus, resulting into a net chargeable gain of how much? Net chargeable gain comes out to be 7,600 less cost of acquisition, enhancement cost. Right. Now, what do I further do? I further avail the annual exempt amount, which is less annual exempt amount, which is 11,100 pounds. How much does my net taxable income come out to be? Taxable income is equals to 44,500 pounds. Now that I've done this, let's have a look at all the scenarios under the part B of the question and find out what is going to be the status of the particular assessee, calculating both income tax as well as capital gains tax, finding out whether or not the particular assessee is a basic rate taxpayer or is it a higher rate taxpayer. So I start off with what? I've got 500,000 pounds of taxable income. Taxable income is equals to 500,000 pounds. Definitely your what? Sorry, this is, the question says it should be 50,000 pounds instead. Let me just correct it. Right. Assuming it is 50,000 pounds because now your level is taxable income plus chargeable gain. Chargeable gain is how much? 44,500. Total is how much? Total is equals to plus definitely what you are. This is greater than 32,000 pounds. So what you are a higher rate taxpayer. Very clearly, because the income is now greater than 32,000 pounds, you are a higher rate taxpayer for your CGT purposes. Higher rate, this is not a residential property. The examiner has clearly told you that this is not a residential property. So what are you going to tax it at? You're going to tax your chargeable gains at 20% liability, becoming a total of 8,900 as your chargeable gains tax liability. Now in part B of the question, we have 20,000 and it does not make any gifted donation. So taxable income is now 20,000. Taxable income under CGT is 44,500, thus resulting into a total of. Now what happens? Your taxable income in itself is less than the basic threshold level of 32,000 pounds. How much of your basic threshold level is consumed by income tax itself? So basic threshold level which is left is how much? Out of the threshold level of 32,000 pounds, you've consumed 20,000 in your income tax. So you still have 12,000 pounds of your basic threshold level, which you're going to pay tax on your CGT at a lower rate of 10%. Why? Because this is still under the basic rate band of 32,000 pounds, which becomes how much? 12,000 multiplied by 10% is equals to 1,200. What about the remaining? Remaining is going to be how much? Out of total liability of 44,500, I have paid tax on 12,000. So the remaining I pay tax at the higher rate band of 20% very simply, which turns out to be how much? Multiply by 20%, thus resulting into a total tax liability of 7,700 pounds if I have a taxable income of £20,000 along with the chargeable gain of £44,500, which I have just calculated. Now let's move on to part C of the question. 30,000 and he pays contribution of 12,000 into a personal pension scheme. Taxable income is how much? Under income tax it is £30,000. What is your rate band? Your basic rate band because there has been a contribution to personal pension scheme. Definitely, how much is the contribution? Let me go back to the question. It's £12,000, right? So definitely your original rate band of 32,000 gets extended by another 12,000 pounds. So up till 44,000 pounds, I'm now going to pay tax at the basic rate, which whatever be applicable. So out of 44,000 pounds, 30,000 pounds has been consumed by income tax. Income tax consumes 30,000 pounds. How much is remaining for the basic rate for CGT? How much it is? Out of the total 44,000 pounds, you still have 30,000 is consumed by income tax. So you still have 14,000 pounds to pay a basic rate of 10% tax, thus making your liability of 1,400 pounds. What about your remaining? Remaining for CGT is how much? Out of the total was how much? 40. Let me just get back to the question. How much was my total income? 44,500, right? So out of 44,500, I have paid basic rate for 14,000. The remaining becomes taxed at 20% higher rate, which is going to be how much? So very simply, what has this resulted? An extension in the basic and higher rate band has thus made me pay CGT at a lower rate at the basic rate band of 10% for 14,000 pounds. Also, let's have a look at the next part, which is what? Let's have a look at the question. 140,000 pounds and pays contribution of 30,000 pounds to personal pension scheme. Now, pension scheme, your basic plan was how much? The basic rate was 32,000 pounds. Having made a personal pension scheme contribution, it results in an extension by how much it is? 30,000 pounds? Right. Thus resulting in my band being, basic rate band being 62,000 pounds. Now taxable income under income tax is 140,000 pounds. So definitely all of it is going to be consumed by income tax only. Thereby I have to pay the remaining, which is my CGT liability gets taxed at the higher rate band of 20%, which is 8,900 is what I'm going to pay tax on my CGT liability. So very simply, what I have done is that I know that my basic layout is what? I now know that this is how I'm going to tax plan for myself. So that's it. Let me finish off today's session because I do not want to bombard you with too much information. We are going to reiterate what we've done today and we are going to go further up with taking on corporate taxpayers as well. So very simply what we've done chargeable gains tax. Very basic knowledge we've done. We know that we need a chargeable asset. We need a chargeable disposal, and this disposal needs to be made by a chargeable person. We started off with the capital gains tax layout, which is applicable for personal taxpayer. So very basics we've done today. In the next session, we are going to move forward. I don't know, a few complications. Move on to our corporate taxpayers as well and understand the basics of it first, right? So that's it for today. Any queries you have, please feel free to email it to me at Shilpi, ACCA@gmail.com. That's it then. Thank you very much for today. Thank you.